Welcome to the Broken Pie Chart Podcast, episode 295. I'm your host, Eric Moore. With me once again is my semi-permanent co-host, Jay Pestrichelli. Jay, another new all-time high, definitely an Apple, right?
I mean, you don't sound excited. Another week of an all-time high, right?
So
and we're
tired
approaching,
of it. We are
approaching your 6,000 number, right? Today we closed at 58.78, but we had that is the high close, the 58.64, but we hit a 58.78 the other day. What did we hit when we opened to 58? 58. So, look, things are moving towards your 6,000 number just in time for the election, I think.
Yes.
Oh.
Well, I'll have to find that episode where I made that prediction because I only go back and find the ones that I'm correct on.
Yes. Well, then that's worth your time. Yes. By the way, I agreed with you, but somehow somebody had to take the other side of that. Who knows, right, if we're still going to go there. But the trend continues to go up, right? I mean, we are following this really tight 20-day moving average on the S&P. Like, if you've been watching moving averages, and we don't usually talk about this as kind of an indicator, but the angle that the market has had really the whole 12 months, with the exception of the two dips, the one we had in April and the one we had in August, the market has been tight against that 20-day moving average, keeps retesting it and goes higher, retesting it goes higher, retesting it goes higher. So look, I'm looking at it right now. It would have to drop to 57.72. So let's call it 90 points below. But that has been where the support has been. It has followed it up very, very nicely. Hasn't sniffed the 200-day, which typically people talk about as a potential support level. Hasn't sniffed that all year. It broke through that on November 1st of last year, and now it hasn't been close to that. So look, this trend continues up and to the right as you're looking at the chart. What else to say? I'm going to go back to some of the stuff we talked about, like September and October this year don't seem like other September and Octobers, right? So does that mean the volatility comes, in November, December, which typically it does not? Who knows if we're going to get kind of a reverse there, but new highs, new interesting stuff.
Okay, so Apple did edge out its prior high. I think it closed right at 235. The prior high was like 234.82 in July. Let's
see here. Like the high of the day, or let's say a few days ago we had the 237. It touched there, but you're talking about today's close, huh? Today's close, 235 on the money, as opposed to other closes, which I think you're
look
right.
At 716, 234.82. So that's got to be.
Yeah.
What's really funny about Apple is that's just we always say all this stuff we're talking about, we buy, we hedge. And one of the core things that we do. And the reason why we do that is because everyone is always trying to figure this out. Like, should I be in the market still? Should I take some money off? I'm going to try and predict when the downturn's going to come. This stuff is hard. So we just rather stay in the market. But as students of this, I remember Apple, there was calls to say, well, I don't know, slowing handset sales. Their best days are over. And even if you look, Jay, at, let's see, this is from Economic Times. I don't know who this is. I'm sure it's a fine organization. I actually don't even know who this is. September 17th. Has Apple's newest iPhone flopped badly? The iPhone 16 is already selling at a discount in China. Fast forward to today, Apple's new iPhone sales in China jumped 20% in the first 3 weeks. Apple makes a new all-time high.
Yeah.
Like,
those are different messages.
Yeah. I mean, it's like, but imagine somebody read that a couple weeks ago and was like, yeah, no, oh boy, this is going to be bad. I'm going to sell.
That's it. Apple's going to flop. I know.
Yeah.
Look, it's always interesting. Apple for many, many years was you and I would look at, hey, what's Apple doing that's going to give me an idea of what's going to happen today, even like a day by day, right? Or if you saw a large sell-off intraday, if Apple could make the turn, you knew the sell-off was over, right?
Yes.
I think you probably remember some 2015s, 2014s, 2018s in there. When those things were going on, you'd watch the hint from Apple that, okay, the buyers are coming in. Now it's more Nvidia, right, than anything else. But love to see that Apple continues to press the market higher. Like it's I think it might be the most widely held stock in portfolios, which is great, right? This is good for everybody. If you're long, you're participating somewhere in this. And if you own the S&P or the Nasdaq 100 or even the Dow, I think who owns the Dow these days? You get a piece of Apple, right? So you're participating in all of this.
We'll get to Nvidia later. I got some stuff there. You know who I think might be losing it as an investor? I'm just going to say it. I'm going to say the quiet part out loud. Isn't that what the soup du jour right now? The way people are terming?
I don't know. Man, I'd probably get in more trouble if I did that. I feel like I was at a conference this week and said too many things out loud. What are you going to say?
I think Warren Buffett's lost it. This is a headline, totally out of context headline because I'm not a subscriber to Barron's. It says Berkshire's move to sell Apple doesn't look good. It may have left $25 billion on the table. That was from October 15th.
Stop. I'm just going to
totally out of context. I know I'm being sarcastic.
By the way, and it's not even look. He's the face of the company, but he has delegated so many of the decisions. Right? He has to. Right? In order to be able to eventually pass the baton at Berkshire whenever his time comes, and I'm sure he'll be like Charlie, investing until the day he stops breathing. Like this is not his call. I don't blame him. Sure, I know the fish stinks at the head. We all know how that is. But this is not the first time we've seen him divest. By the way, they're not out of Apple. They still hold plenty of Apple. They just now hold less. They didn't sell it all.
Do you remember? All right. Well, I'm still going to put in the title of our episode to get clicks. I'm not against doing that.
Lost it. Yeah, stop.
Yeah, that will get some clicks. You and I actually discussed on the podcast when this happened, though. I had read a piece, might have been from Bloomberg, saying, in a weird way, because the held or the available float changes, because I guess Berkshire, their holdings aren't really liquid or how that works. But the indexes actually had to buy more Apple when he sold. I think it was a piece in Bloomberg. I don't know where it is, or otherwise I'd link to it. So in a weird way, he might have helped juice Apple a little bit by doing this.
He helped himself.
Well, yes, he owns some too, and he took a little off the table. What do we always say? If you're unsure, just take a little off.
Take some off.
All right. Okay. So I put together, as I normally do, a list, and now we're on different pages. So let me get back to the top. All right. I think the narrative right now, and I'm not a big fan of sitting there watching CNBC because it's like somebody comes on, well, we like XYZ, or we like small caps or large caps, or we should be overweight EM, or this is changing a little bit. Total returns from end of September, so September 30th, S&P 500 plus 1.76, Russell 2000 plus 2.16, and the X index, that's the Nasdaq 100, plus 1.34. Emerging markets through EEM, that's an ETF, up 10 basis points, and developed Europe or developed markets, well, basically it's Europe-centric, EFA minus 2.1 and AGG minus 1.4. All right, so I have comments on all these, but it's changing. Like, remember we said it was all Nvidia all the time, and Nvidia's had a nice little run, but small caps are getting their day in the sun, it looks like.
Yeah, so small caps, the best kind of performing of the group between S&P small caps, Nasdaq, emerging markets, developed markets, and bonds. Yeah, so small caps best. Great. I mean, we talked about small caps, I think, last week, and
we did with the earnings projections, which are
very
crazy
interesting data points with that. Yeah. This is a very short period of time, right? We're talking about 3 weeks here.
Totally arbitrary. Yeah.
I mean, you picked the beginning of a month, which is nice, but the S&P still holding in there strong, right? But I think you got to get through earnings, Derek, before you give the Nasdaq its ding. Like, this is very typical leading into earnings. Nasdaq, many quarters. We've done studies on this before. You and I have actually made investment decisions based on this. Nasdaq will look weak. It can look weak going into earnings, and more often than not, I don't know about this time, more often than not, the end result is they're all, the majority of them are stronger afterwards. So, S&P is going to participate in that, of course, as well, but the rut won't. So it'll be interesting to see. I would give, let's talk about this in another 2 or 3 weeks after we've heard from, the Mag 7 and such, that we shall see where this lands.
AGG, by the way, is down 1.4% on a total return basis.
Bonds?
Yeah, AGG is bonds. Yeah. And, what's interesting about, bonds is, remember we said everyone's going to be like, oh, the easiest trade, the easiest investment is just simply go into bonds and maybe longer duration. The 10-year is up over 4%, 4.083%.
Up, and you mean in yield, which means price down.
Exactly, since the Fed cut rates. So the short end has been, I think there's been a readjustment, let's say in the 2-year. I mean, the 2-year yield it was over 4% yesterday. Today it's slightly under, but that was an interesting one. Anyway, coming back to this, we don't have to spend too much time on it. I just think, like, anybody go watch CNBC for a little bit and you're going to see people being like, oh, I think the Trump win is getting priced into small caps. Like, it's just a revolving circle of what everybody says. Like, somebody says it, someone else says it. I don't know. Hopefully we say different things on here or give a different viewpoint. But that's the narrative right now.
Okay.
All right. You want to scare some people?
I mean, everything so far has been rosy. Let's hear something scary.
Auto loan serious delinquent 90-plus day auto loans are up. There's a chart. This is from Bloomberg Intelligence and Arbor Data Science. I don't know. There's a couple different names on here. We'll say them all, and we'll assume one of them put this together. This shows a chart of total auto loan debt balance, which is now $1.63 trillion. And I imagine this is just in the U.S., although it's not labeled exactly that way. And then the other thing is the serious delinquent 90-plus day auto loans, 2.88%. It's the highest it's been since 2011. Okay. Should we scare people? They should sell everything and run and put it under the mattress, right? Because this is...
Look, obviously, defaults usually, indicate weakness. But
yes.
All right, I have 2 comments on this. Like, 2.88 is like, we're really up from like 2.4 just a few years ago, like pre-pandemic, right? The 2020, 2018, 2016 default rates were, around the 2.4 range, just shy of 2.4. And now we're over at 2.8. I mean, to me, that's not a big change here. I would be more interested, by the way, I'm not surprised, because guess what? Interest rates were higher the last bunch of years. People had to pay more for cars. Like, you remember when, used cars were getting more money than new cars. We were able to buy, you had to buy a used car for more than a new car because the new cars weren't available. Like, you remember that, that inversion in the auto market. So look, I am not surprised that there's some fallout from that people bought cars that they didn't have to compare. I'm sure they bought it thinking they could and or that they had to, and they paid more, and they borrowed more. Not to mention, loans these days are very different. I think you could get a 7-year loan for a car. Like, that didn't exist before. So guess what? Hey, the longer duration the loan, Derek, more risk of default. This is normal stuff. So I think that, this is not upsetting to me at all. I'm glad you brought it up, but this is a bunch of meh to me.
All right, I'm going to take the other side just because it's good fodder for the audience. First, I think you and I would both agree, when you show a total loan balance and you don't inflation adjust it or anchor it in $2010 or in $2024, like, yeah, of course we've had inflation, and you got to inflation adjust the totals. The percentage, though, I would say, look at right around 2008, 2009, probably crested out and spiked to about 3.5%. And that 2.85 was when, after the high point in loan defaults, or people who were 90 days delinquent. Doesn't mean they actually defaulted. They're just delinquent by 90 days. So the counterpoint is here, no, I mean, this is rising, and it's been rising. And I mean, if 2009 was really bad and that's what it got to, this tells me we're getting to some levels that we haven't seen since 2008. How's that? Am I scaring people enough?
No, no. Again, I think.
But what about the stimulus, Jay? Come on, like the stimulus was out there. People were getting checks out the wazoo, and now they went out and they financed the car, and now the checks aren't coming in anymore.
Okay, surprise. I mean, do Americans make commitments they can't totally keep up? No, yeah, of course. I would be more concerned with credit card debt, Derek. Show me credit card debt, which that is a bigger deal to me, right? And the auto stuff, again, I just think the environment has changed. It's different today than it was in the timeframes you just mentioned, the 08, the 09 periods. I just think the lending industry for autos is just different. Pricing is different. We've talked about this. I think cars are super expensive right now. I don't get it.
By the way, I have no idea what's going on in this market. There are people in the audience who probably actually do, and they're like, these guys are a bunch of clowns. So let's go back to
just winging it. But it tells you to seriously, you see information like this, use your brain and interpret it, and just don't be like, whoa, we're record high since the last time. Well, it wasn't even since the last time we had a major.
Are you talking to me or are you talking to the audience?
I'm talking to anybody, the audience. Right? You too. You should use your brain. But just always question, is this really a relevant comparison?
Where this showed up, though, is on Twitter. And it was, I believe, from an account who reposted this chart, who is always kind of doom and gloom. So any negative news, they bring it out.
Yeah, so the doom and gloomers are scraping the bottom of the barrel to scare us right now.
All right. We'll watch car loans, auto loans. I did read, by the way, that Stellantis, I think I saw this locally, they're closing down their Arizona proving ground area. Maybe they should make better cars or not change the design of their Jeep Grand Cherokee that everybody liked and now they're not.
You don't like the new Grand Cherokee, the big box?
No, it's the front grille. I don't like it as much as the old ones.
I kind of like it. It looks great. I'm going to tell you a Jeep story. You ready?
Okay, I'm ready.
So my son was in North Carolina when Helene hit, and he is fine. But that part, the mountains of North Carolina kind of got whacked, and there's a lot of trees on the property where he lives, and a tree fell right on his Jeep, 7,000 pound tree, humongous old 80-year-old tree, falls on his Jeep, then stops and lands on the corner of the windshield, dents his hood, wrecks his soft top. It dents the frame of the windshield. That's it. The windshield didn't even crack. This huge tree falls on his car. Wow. Windshield didn't even crack. He has a 2010 Wrangler, four-door Wrangler, and he had a lot of custom stuff on it. And this thing held up like a champ. I was very impressed with the Jeep taking the direct hit of this humongous tree falling on it. So we had fun with the chainsaw. We went up there that weekend and cut it all off and everything like that. And then we proceeded to make a fire with it. And we all, made
with the Jeep or with the firewood?
With the firewood.
With the firewood.
We took the Jeep. We drove it to the dealership to go get it fixed. We just drove it away. It was great. So I was happy with the Jeep Wrangler.
Well, I have a 2008 Jeep Wrangler that I still drive. That's my.
You still drive that?
People make fun of me.
But why? Because you're an old guy in a Jeep?
No, because I haven't gotten a new car.
But why do you need one? Do you need one?
I don't.
Maybe you should get an auto loan. I heard the default rates are pretty bad right now.
All right, let's get back to the market. So, by the way, I will tell you that is impressive. And my Jeep, knock on wood, I don't want to get into any accidents, but I've been in an accident. Somebody hit me from behind, and it held up. It really did.
Yeah.
So that's impressive.
His is a little decked out. We put steel bumpers on it. There's a winch on the front. Everything was ready except from a hit from the top, and it handled it really well.
So with the winch on the front, he could drag that tree.
So as I was trying to figure out how to get the tree off the Jeep, I was like, all right, we could use the winch and just kind of, pull it around, pull it off. The tree was so heavy, what it did is the winch lifted the Jeep and not the tree off the Jeep. So
lifted the Jeep.
So just imagine the winch kind of went up and over and down, out of little quasi pulley system and down and grab the tree. And I thought was roll the winch up and it'll pull the tree off the Jeep as the winch is rolling, right, and pulling it up. But instead, the winch lifted the Jeep up. So we know that the tree weighed more than the Jeep.
Okay.
That's how we at least it weighs more than the Jeep. Just, the one pulley thing didn't work. So, but anyway, just there you go.
When you live in Florida, I was going to say you could take home a bunch of firewood, but I don't know what you would do with it unless you have a bonfire outside by your pool.
He's going to use it in North Carolina.
Yeah, no, he will. All right, back to the markets, Jay. The bull market might be 2, but it is still young. This is from Ryan Dietrich. He had put this out. And all right, so this is 1950 to current. And what he did was he looked at bear market bottoms to the next bull market peak and the change in the S&P 500 and the number of years. So we're basically 2 years from trough to, we're at all-time, we keep making all-time highs, but we're basically 2 years. And sure, the 2020 one was 1.8 years, but a lot of these are like 11 years, 09 to 2020, 5 years, 02 to 07, 12.3 years, 87 to 2000. So his point is that we're still early, I think is the point he's trying to make, right?
Yeah, he's saying, yeah. So in this definition, I'm assuming it's a bull market continues as long as there's no 20% decline in the middle of this run. Is that correct? So because that's defining a bear, the 20% decline?
Well, I don't know. I think because if you look at the 10.9 of 02, that was the bottom. Was 10.9 of 07, was that the top? I think it's the top, whatever the top was.
But between 2002 to 2007 is just saying there was no 20% decline.
Yeah, you'd have to assume that. Yeah.
Okay. So that was the first thing I just wanted clarification. So, by the way, your impressive period that you always talk about is smack dab in the middle of the 87 to 2000 run, right? That's 580% run over that 12-year period. Are you telling me there was no 20% decline during that 87 to 2000 period?
I doing it off memory, but
pretty impressive. Right?
Yeah, I don't think so.
Yeah. So, look, so this tells you, markets are, but there's plenty of data points here that are 2 years old or 3 years old.
Mm-hmm.
I don't. Sorry to be a Debbie Downer. Wah wah. I don't think this tells me we've got to. Yeah, sure. Bulls can go longer. They have rarely been younger than this before they died. So. Yes, there is a lot of runway if you're using this and look at the last bull markets to say, sure, you could go a lot longer. Just, visually looking here, the average is probably in the 6 range, 5 to 6 years, with a handful of double digits. There's a 12-year one in there. There's an 11-year one in there.
Mm-hmm.
So, sure, it's young, but there have been younger. There have been ones that have been this age before they died off. But I'm not saying you should disregard this. I'm just not saying you should take a lot of, a lot out of this. What I think is more interesting in this is that 5 out of 12 of these bull markets started in October, right? Which, we've talked about October being a weak point in the market or a volatile point in the market. So of October 2022, which is when he is claiming this current bull market started, and we're up 62% since then. Interesting that they started October. It doesn't help. We're in October now. We're in the middle of it. I don't think it tells anything between now and the next October. But, markets selling off and bottoming out in October, yeah, that jives with what we've said before, for sure.
October 9th, 2007 has here as the peak. So there was a peak in October. I'm trying to see if there's any other peaks in October. Nope. That's it.
No.
The only thing I would say is I don't know about doing, do you do a market bottom to the peak? And Guggenheim used to put out these charts. I'd have to look and see if they still do. And they would measure these regimes, these really more, what they call it, a cyclical bull market, where, for example, we made a high in, what was that, in early 22, right around 4,800. and then we have a bear market, and we don't make a new high until we don't eclipse the old market high until what, January of this year.
All right, so getting back above that high of January 2022.
Yeah, I think Guggenheim, the way they used to do it, would say the bull market didn't start until January of this year, because you have to make a new high.
So when the drawdown is over, right? That's another way to say it. Drawdown is is definitely a term we use a lot when it comes to investing. And the drawdown, there's a max drawdown, how far it goes down, but then you measure how long until you get back above where you started the drawdown, started the decline. And so that's the argument you're making here.
Yeah.
Like, really, you shouldn't have started it in 2022. That's what you're saying. You're saying, hey, we should have started at the beginning of this year to see if we're in a new bull market. I'm not sure I agree with that. I mean, you hear people would refer to, hey, the market's up 25%. They don't really reference previous highs. You look at these bull markets and these periods of growth. I don't know. I think maybe you're measuring different things. I don't think you're wrong what you're talking about. Just don't know if when the whole bull or bear market thing is defined there. Like if you were in maybe this, I'm about to burn my own argument. But when you say you're in a bear market and you had a 20% decline, you could have multiple kind of rebounds in the middle of it, but you always measure from the previous high to the bottom. So maybe that's one of those things, Derek, like, it matters where you start. I'll tell you, quite frankly, I would agree, though, generally that whether this bull market started in 2022 or the end of 2023, we're in a bull market, right? You can't argue that part.
I found Guggenheim's thing. I'm here. I'll send it to you.
Did I give you enough time?
Yeah. There you go. I knew I could find it, but the point of the old high to the new high is that, in theory, if you invested at the old high, you're not making money until it makes a new high. But Guggenheim they have I'll link to this so our audience can find this. S&P 500 index historical trends. I don't know the end date of this. 1.2 years was there. Yeah, it doesn't say when the as of here.
I mean, it looks like the last data point here is 4,700 on the S&P. So you can use that as maybe your benchmark looking back when that happened, which was, pretty much when that old high that we talked about.
Yeah. All right. I think this is all right. We're done.
What's your point? Good market. It's okay. We might be young in the bull market. Probably accurate.
Well, either trough to top to most recent high, where we're not crazy extended, and then if you do it the other way, we're not even a year into this. So there you go.
There you go.
All right. That's why we hedge, though, because we have no idea what's going to happen.
We don't know.
All right. I want to talk about Nvidia. I teased it earlier. I see this coming. This was out there for a while, and then it's been coming up again. I've been seeing it being posted on Twitter or X. Well, X is Twitter now. And it's the chart of Nvidia versus Cisco. So what they're showing is, and this is from Kevin Smith using Bloomberg, Crescat Capital. Okay, so I sourced everybody there. Nvidia 2024 versus Cisco 2000. This is enterprise value as percent of GDP. Okay, it also looks like a price chart. And what they do is, it's the chart of Nvidia, but then they sort of use the same time scale, and they fast forward like the chart of Cisco, so that the high of Cisco met with the high of Nvidia.
Yeah, it looks like they shifted the Cisco chart, right? They took that performance and just laid it over this, yes.
And I think the point they're trying to make is these charts look a little similar. You have the unbelievable run up. You've got, and they're trying to say that's what's going on with Cisco, with Nvidia right now. So I don't know. Have you seen this? Have you seen these around?
I mean, I've heard people talk about Cisco versus Nvidia, and look, I get it, but I never got this. Cisco never felt like the way Nvidia feels today to me. And I understood they were the picks and shovels of the internet, as you like to call it, right? Yeah. I would tell you that maybe Nvidia is that of AI, although it feels like it's maybe something else here. So, yeah, I've seen it. But I think there are other high flyers I would compare here. But yeah, I'm again, I never really connected those dots too much, but I definitely have seen people talking about it. So what do you think? Is this like an accurate comparison? Should we be worried? Because what people can't see on the graph is, as you know, when Cisco peaked in 2000, it proceeded to sell off dramatically and has really been sideways, for the last 9 years.
It's never made a new high. Not
even been close. I don't even think it's got halfway there. So
well, and it's the question I asked myself, and I said, well, how would I really do a comparison? One of them, I guess, is look at the forward PE ratio. And so I went back and I looked at Cisco's chart in the late 90s, early 2000s. So they kind of peaked in probably March of 2000, somewhere around there. And what was their peak in forward PE? Well, it was actually probably like 85, a forward PE, maybe 90, maybe more. Probably 85.
Remember back then, that's what tech companies were getting, those kind of PEs.
Sure.
Even more.
Well, what about Nvidia though? Nvidia, and they pretty much made a new all-time high as of, they made a new all-time high. They're at about a 48 forward PE right now. So no, their PE,
the PE is like half of the high in Nvidia, you're saying, right? So we'll say the fluff, the forward-looking, all that kind of stuff. The optimism was more for Cisco than where Nvidia is.
The thing that's interesting with Cisco though is starting in, let's say, 90 up and through to the start of 2000. Their forward PE was between 20 and 40, and then their PE spiked as price spiked. But Nvidia's PE is actually, it's not made a new high. It went above 60 in 23, above 60, call it, in end of 21, early 22, touching 60 in 2020. So their earnings, although their PE is still 48, their earnings have gone up. It's just a different nuance where I think it's different. The other thing, Jay, I looked at, I said, well, what about the profit margins? I looked at net profit margins, the percent in the late 90s, early 2000s for Cisco. Late 90s, they were around 15 to 16. They actually had negative profit margin in 2001. That's after they sort of crashed. Nvidia, their worst year was a net profit margin of 15, going back to 2017.
Their worst. And that was Cisco's average, yeah.
Look, I don't know what these stocks are going to do. I don't know what Cisco's going to do. I don't know. Do we even follow Cisco anymore? Isn't even the consciousness of the investors? I have no clue what Nvidia is going to do, but I think it's different. I think just it's not the same frothiness.
All right, if you had one that you'd like to compare Nvidia to, what would you pick?
I think Intel. Intel, because Intel was, remember the picks and shovels, like Intel was the chip for all the computers, the breakout of computing, right? Cell phones, all that stuff.
What happened to Intel? Not a great story there.
Are they going to get kicked out of the Dow?
Have they not already been kicked out of the Dow?
I think they're less than 1% weighting though.
Wow.
I don't know. Speaking of changes to the index, I know I'm the only one who watches this. So I like to look at when the S&P 500 adds companies or takes companies away. And the reason why is the S&P aggregates all the earnings together. So if you're bringing in stronger companies, we always think about, what's the next year estimate for the S&P 500? Those are all the companies put together in a bag. And if you're bringing in stronger companies and getting rid of weak ones, well, that should help the earnings growth or help be a little more robust. I don't know if you knew this, Jay, but September 24th, S&P Global announced that Bath and Body Works, didn't it used to be Bed Bath and Body?
Is that the same company? Bed Bath Beyond? Bath and Body Works?
I have no idea.
All right. Bye Bye Baby. Wasn't that it? Oh, maybe that's Best
maybe
Buy.
They were an offshoot of them.
That's Best Buy. Okay.
Was the bed not making any money? So they just like, hey, Jim, I know you love the beds, but we got to get rid of the beds.
We got to talk more about bodies.
Bodies and Bath.
Bath, you stay. Yeah.
So they are going. Yeah, they were kicked out of the S&P 500. They'll be moved to the S&P small cap. And in its place, let's see, who is this? Amentum, symbol AMTM. I have no idea what this company does. But they, according to, I guess I could just look at the write-up here. According to them, so this is company Jacob Solutions. This is the great thing about when you do individual companies in the S&P. Sometimes you learn who's in there. Jacob Solutions, symbol J. Pretty good symbol, by the way, that they nailed.
It could be my favorite symbol.
J. Yeah, well,
J.
There you go. So apparently they did a spinoff of Critical Mission Solutions and Cyber Intelligence, and they spun it off into previously privately held Amentum, creating a Amentum Holdings. The statement from the index provider was, Bath and Body Works is no longer representative of the large cap market space. Jay, when I look, doesn't BBWI and AMTM have the same market cap?
Yeah, basically? BBWI's got, $6.998 billion of market cap. And I think this Amentum, which now I got to relook back to, it was like 7.1 billion. Yeah. So very, very similar market cap. I mean, what is the expectation that it's going to go up and have more market cap? Maybe that's a bullish trigger. I don't know.
I have no idea. They did have something in here. This is another article. It's not, according to S&P Dow Jones indices, a company must have a market cap of at least 18 billion to be eligible.
Well, I just said it was 7.
This is a mystery. Let's let our audience loose on this one.
This is a crime that's happening in the S&P composition market.
Yeah.
All right. Well,
I love, though, when the companies come in and out. Like Dell was added. Weren't they added a month ago, I think? Dell was earning.
Streams that they weren't before. By the way, they had a great run, Dell, right? Have you looked at a chart of Dell?
Yeah.
Recently? Right.
Well, think about that. He went private.
Yeah.
And then can I tell you a story that I spent about a month in Austin, Texas, and this was back in the Ameritrade days. So we had first time we opened branches, and we had opened one down there, and I went down to help open that one. And where the branch was located, I don't think it's where it is now. I don't think that branch is around anymore. But on the second floor was the Dell Foundation. But they were so nondescript, like they have no signage, whatever. And we got a package one day, and I just went upstairs and opened the door and came in. And it was like I was breaking into their office or something. And I talked to them, and apparently they kept it low key. This is what the person told me, because they don't want people coming by to try and get money and stuff. So that's why she was like, "Why are you in here?" But when I'm talking to them. And that was the Michael Dell's foundation.
That's your Dell story. Oh, that's nice. So there's Michael Dell's foundation. Okay, got it.
Yeah. It's a Yeah, exactly. I bet I make that clear. But they were just like, "Why are you here? Like, what are you doing here?" I'm like, you got a package. Yeah. They delivered it to us.
All right. Well, look, we can come back to this. Interesting. Maybe we'll keep an eye on this AMTM.
Yep. All right. We'll keep. No, we won't.
No, I'm going to correct myself on Dell. It did have a great run through June, had a big sell-off after earnings. It's trying to recover, but it's not back to where it was before its June earnings, and it's got a little ways to go. So trading at about 126. The chart's fine, but it's definitely been a little rocky.
All right. By the way, I'm not going to promise our audience we'll ever come back to this AMTM.
No promises.
Yeah. But if they want to look into it and tell me why... it replaced.
I think the first person to write you back in 6 months with an Amentum update should get, a copy of the of the Broken Pie Chart.
Yeah, Broken Pie Chart would be a good book to get. We do have Halloween coming up. No better thing to give out to kids. And also, if you give Buy and Hedge your book, nice tandem there. It's a little heavy.
Yeah. I mean, both of those you give one together. To the brother, the sister. You could break it up a little bit. It's fine.
Yeah, they could split the books. And send me emails. Derek.moore@zegainvestments.com. DEREK.MOORE @Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly. We have done a listener question segment in a while, so if you have questions, send those through. Jay, let's go to Netflix. We talked about it last week, and I looked the day before, so this would have been yesterday afternoon.
Yeah, the reason it's interesting, right? Because earnings. Yeah.
Yes. So earnings came out after the bell yesterday. If anybody didn't know, it jumped. So the street liked it. I looked, and the implied volatility was around 146. And, 146 implies what? About a little over a 9% move implied over the next day.
Yep.
The straddle, which is where you buy the at-the-money call, buy the at-the-money put, would have cost you about $51. So you break even, the stock got to 639 and you bought the straddle. I think it closed above there. You would make money. If it got below 637, you would make money. So I don't know. If you bought the straddle, did you make money on this one?
You didn't. It had a nice move, right? So, up 11% today, up $76. Wait, did you make it? No, because the straddle was, how much did you say the straddle was? Oh, 60. Am I reading it wrong?
Oh, yeah, no, you made it. Yeah, because about 739 was break even. So it's 763. Yeah.
760. Okay. Well, that, and I'm going to tell you, I was watching it last night after earnings on a flight back from Utah, and I was like, that was good, but not good enough. And then actually had a nice little move today, right? So you got the little aftermarket, move up after earnings last night, gapped up today at 730, and then continued to move up another 34 points. Yeah, pretty strong move on that one. I think we talked about it a little bit. We were talking about 780s, 770s as a potential strike that looked interesting based on the price last week when we were talking about it. So it's funny that it's doing what was predicted. Normally that doesn't happen.
No, it's always tough coming into earnings because one side of the coin says you sell the straddle because it's very expensive. And obviously if you stay within those break evens, you make money. Other people buy the straddle. And it's really a coin flip on which way. Like United's one where I think if you bought the straddle, it would have worked, but there was another one you would have gotten killed if you bought the straddle.
There are just some stocks where the option implied volatility tends to be a little higher than what the real volatility is, and somewhere it's lower, right? Like we watch Palantir quite a bit as well, and that is one where the options, don't really, reflect what the actual movements of that stock can be. And it's weird because it could be flat, and then boom, 4% move in one day. Meanwhile, the previous days it moved a total of 0.25%. So, very jittery, I'll call it. And that doesn't mean down. It just means, it's a little spastic in the way the chart can look day to day. You don't always get that. But you look at a Netflix. All right, that's a chart that I think is also continues to be interesting to watch. Like Netflix has had a really we talked about it last week. I won't dig into it too much, but that run has been fairly strong. I guess after today, let's see where we are. So we talked about last week that a year ago it was trading at 404. Today we hit that 765, 66 level. Strong, but it has not been smooth, right? It has not been as smooth as say the S&P has, but you've had lots of chances to buy dips on this one and continue to ride it up. But that's a nice channel, right? Higher highs, higher lows. I don't know what it's going to do from here, of course, but that is, you're looking for a bullish chart, look at it. And everybody had written Netflix off.
I mean, their high was end of October in 21. They were right around, 690, something like that. So, you bought it there, you didn't start to make money again until, end of August?
And that was a pretty nasty ride, right? You took it from, just under 700 down to 160. What do we got here? 163. But if you're doing your bull market analysis, you would say it really hasn't started yet with that run from 163
just started.
To where it is today, 700, that's 700, you'd say, okay.
Yeah, well, that's what the Guggenheim charts used to do.
Yeah. All right. So, well, listen, Guggenheim, just because they got a funny name doesn't mean they're the smartest.
Do you really think there's, with technical analysis, the idea of resistance and support and resistance, is the idea that if you get to a high, there are people who bought at that high. And then the idea is, my dog is very excited about this for some reason.
Because you said Guggenheim. Isn't that your dog's name? Guggenheim?
No, it's not.
Oh.
It's not. His name is Owen. He's character from, what's the dinosaur movie?
Don't know.
No, the big one Michael Crichton wrote. Why can't I think
Jurassic Park?
Yeah. There's like a character, and my son.
You liked Owen?
He did like the name, and that's
wasn't the one Newman played, right?
I have no idea. So where am I going here? Resistance support. The idea with when the stock gets to resistance, it makes a high, and then there are people who bought there. And if the stock comes down, there are people who are like, oh, I'll only sell if I get back to break even. So the idea is that you have old holders. And that's the theory. So if a stock gets above its resistance point, that's bullish because it means there are more incremental buyers than the old holders who said, just get me out of break even. But I don't know who held it. I mean, from 690 down to 200.
Can I talk about the break even thing for a minute? I think this, I don't know about you, but this irks me. So I'm gonna pull an audible on you here.
All right.
So if holding a stock to get back to break even is kind of silly to me, right? Like if you have losses in a stock and somehow you didn't get out early and you find yourself like, well, I'm in this position. I've got losses here. I didn't get out. Now I went from trading it to now I'm a long-term investor, right? Mm-hmm. And we've seen that. And if you had gone through that run in Netflix, you probably felt that way. But you have to ask yourself, is the best way for me to have my portfolio appreciate in the thing that I wrote down during the depreciation, right? You don't have to make it back the same way you lost it. We had a client the other day who said, I did a trade and we sold some calls and the market's up and I don't want to get out until I get back to break even. My answer to that client is, why? Who cares, right? Like if that's no longer the kind of position you want to have, be done with it and move on and figure out a better way to deploy your capital. Like don't get stuck in the break even mentality. We have seen it in some of our strategies, even if not that many of our strategies lose money, but a 2022, I should say, not a lot made money that year. We saw people as soon as they got back to, we got back to the previous high of 2021, rotated into something different. And my question is, why didn't you do that sooner? I'm happy you stayed in it and I'm glad we got you back to break even, but that might not have been the way you needed to get back to break even, right? There might be other ways for your portfolio to appreciate. And my next comment is your portfolio should be what you want from here on, right? If your goal is whatever your goal is, make sure that the construction of what you're holding, whether it's a single stock, whether it's a basket of stocks, whether it's bonds versus equities, whether it's, gold and oil and alternatives, make sure that that's the right mix for you at that time, right? Don't hold on to a holding that just I'm waiting for it to get back even before I get out. It's irrelevant. It is irrelevant of when you want to get out. You should be asking yourself, what's the best way forward? And if what I had that lost money isn't the best way forward, then you should get rid of it earlier. Don't wait till you get back to break even. You should have moved out. The odds are, by the way, if it's gotten back to break even and now you're selling at that level, a lot of times highs beget higher highs. It's just one of those things. So I don't know, Derek, I don't know how you feel about that. I don't know if you go through that, but it's frustrating for me to hear people say, well, just, wait till I, break even and then we'll move. Just move now if you want to move.
Well, if they knew the future, they would have moved before the downturn. Like if you knew, people make decisions. And they make decisions and assume that they're right this time. But let's look at Netflix. I mean, and it's totally irrelevant. This isn't an actual story I'm telling for anybody who held Netflix. But like, if you're so certain right now that you should get out or get in or do something, why didn't you get out when it was at 690 in October of 21? You know what I mean? Like, people make investment decisions and they say, well, we're going to, the market's too high, I'm going to get out, or now's the time to go into something else. More often than not, those decisions they don't really work out. because you're assuming you're right now. And my question is, why didn't you get out before they went down? If you're right.
Yeah. All right. Well, so the break even thing. Go ahead.
No, I agree. I mean, it's like, but it goes to the emotional side, because if somebody takes a loss and they don't wait to give out a break even, they can't tell their friends at the country club that, yeah, I mean, I waited. I waited to.
Well, they only tell their friends at the country club on the trades that work. I always ask. I'd like to judge an investor better by their losses and the way they handled it than their winners. Right? Everybody's got winners from time to time. That's great. We all remember those because those feel good. And nobody wants to brag about, woo, I took a 30% hit on that guy overnight. But the point is, how you dealt with it is a better reflection of you as an investor and your sustainability and your investment choices than any of your gains.
I'll bring it back. So Jack Schwager, who wrote Market Wizards, I think it was Mark Minervini in the chapter that he profiled that, him as a trader. Mark Minervini had this great quote: "Being wrong isn't a choice, but staying wrong is." One of my favorite Jack Schwager book quotes.
It's a good one.
Yeah. I'll recommend, if we have people in the audience who are interested, maybe they're taking a small amount of their money. You call it the inner guru in your book, Buy and Hedge. Nice Halloween gift. I don't know why people wouldn't get that, but
just a basket, just a stack of them by the door, handing them out. That's
right. Yeah, probably best. Order in bulk. But it's like, if somebody is interested in trading and maybe on a small portion of their money, they want to be more active, but they want to learn how really, really good traders sometimes approach risk, and they don't care about losses. Like, good traders don't care. It's not that they don't care about losses, but they're not going to hold something just to say, well, I can't sell until no, to your point, Jay, like they blow up a portfolio all the time. Hey, it's not working. We're going to change. But Jack Schwager's Market Wizards books, there's a number of them. And I think one of them is Stock Market Wizards, that would, more focused on stock traders. Check those out. Those are, I wish I still had the interview where I interviewed Jack back. We used to do the market huddle at Ameritrade. You remember those? I
do.
He came on for an hour. It was great. He was great. It was great to talk to him about the books. So, all right. I'm calling it, Jay. That's it.
I was going to ask you about gold.
Oh, did we make a new all-time high?
Yep. Past 2,700 this week. I think it was even up today.
So why is that? Why is it making an all-time high now as opposed to when inflation was really high?
Well, look, I read an article that said some people are planning on the resurgence of inflation, and gold is their purchase to offset it.
So gold's going to do well in an inflationary period when it didn't do well last period?
I didn't write the article. I'm just telling you, I read one on Bloomberg that said that. No, look, how's the dollar doing? Right, that's the first question I like to ask when I hear about that. Right, and but let's take a look. Dollar's doing fine, right? The dollar index, right? Little appreciation here. It's actually might have hit a double top here, but I would say it's not that. It's something else, right?
It's the debt that's going on, the government debt.
I'm going to tell you, I bet it's Costco. I'm going to say Costco did it again. They're putting out, you want to buy gold, you buy it at Costco. Although I told you I bought my gold at Walmart instead of Costco because Costco was out. You want to buy gold? You can buy gold little bars from Walmart if you want.
Yeah, no, I know. By the way, there's for the conspiracy theorists out there, there is a report that comes out every week where the Treasury updates the debt. And somebody put out that they were supposed to release it on the 10th and it hadn't been released yet. And they're claiming it's because of the election.
It is a conspiracy.
But no, back to gold though, in all seriousness. I mean, maybe it's the debt. Like the deficit is, we're running a really big deficit right now and there's no debt ceiling anymore. So is that the reason? Here's the thing. It's always more buyers than sellers. I'm sorry, but that's how it works. So then you look at what's the reason. Okay.
Why are there more buyers, right?
Yeah. Why are there more buyers? And maybe the sentiment is this debt is getting out of hand and we got to this is the way to play it. I don't know. What do you think?
No, I don't know. That's why I brought it up. I think it's not an asset that a lot of folks have. I think it fell out of favor, right, for quite a bunch of years. Just seems to be interesting to watch. Somebody's got to be buying gold, right? Somebody's got to be willing to pay $2,700 an ounce, and so you've got to have a reason to purchase where it is. I still don't think it has much industrial utility. So to me, it actually could be a little bit more of a bullish indicator on the economy. I know nobody really ever looks at it like that way, but I think about it. It's you think about who's buying gold besides people that are sticking it in their safe or they're buying it for jewelry, right? So it just seems to me it's one of those things. It tends to kind of people have to come up with the cash to pay that much for gold. So. Seems to me it's a little diversifier, right? Storage of value, but things have to have gone well to get you to that point.
There is, if I knew you were going to talk about gold, I probably, maybe for a future episode, I'll reach out to our friends at State Street. They happen to have GLD and GLDM, two of the gold ETFs, and maybe they have some research on hypothesizing as to the.
I think that'd be worth it. Let's bring it back up.
Yeah.
I know oil has a lot of other things that go into it, right? Oil's been an interesting story too, but gold, every once in a while we bring it up, and I just thought I'd mention it. Another, new high for gold.
I mean, we've got one of our Zega Investments strategies that has a small piece of gold in the portfolio, and it's one of those things. As the diversifying agent, sometimes in a portfolio it could. Be a ballast, and the fact that it's been making new all-time highs is, I guess it doesn't surprise me, but why now? Why not when there was inflation? You would have thought.
Well, yeah. I mean, I think it definitely failed in that scenario, but new high there. You know what else is kind of pressing up against old highs? Don't
come on. You're going to do Bitcoin?
I mean, I guess you did know. I guess you knew it was there. So
it's let's see. Bitcoin has not eclipsed its March. It's March 24 high.
Nope, it sure is getting close though.
Yeah. So on an inflation adjusted basis, if you bought it then, you'd be losing money. You'd be losing purchasing power, right?
We're going to do inflation adjusted on every every asset. Okay.
Only when it suits my argument. When it doesn't, I don't.
It is your podcast.
No, but. So Bitcoin is interesting because, I mean, look, it's 85,790. When did the ETFs get approved? When
April.
Was that? Was that April? Okay, so there was a run up. Excuse me, end of January into February. Is that the reason?
I think there were two reasons. There was the halvening, and we talked about that before, and there was also that there was going to have to be, these ETFs were going to be available, and they'd have to buy it because people were going to start buying, right? And there was billions of dollars that flowed into those ETFs day one. So I think, yes, some of it, supply and demand, right, definitely drove some of that for sure. Yes.
Are advisors using Bitcoin?
No.
I don't think so, right?
I don't think so either. I mean, you want a little, itty bitty piece in there, fine. But no, I don't think so at all. No, I don't think they're using it as their, unless you're going to have a strategy dedicated to it, right? There's hedge funds and private equity funds that will, run, based off of Bitcoin all by itself. But as kind of a standard allocation, like gold could be in an all weather or all decade portfolio, some of us may say, it's one of those things that you won't find Bitcoin in those, I don't think, very often. We've had a lot of folks talk to us about Bitcoin. We have some funds that use that, but there's a lot of interesting stocks too that are tied to the price of Bitcoin, right? Coinbase, MicroStrategy, Mara is a real popular one these days. So you could find a lot of exposure. That seems to be the way I think advisors will play crypto, which is invest in the companies that it's a large driver of their price. But in and of itself, I haven't seen a lot of advisors make it a part of like a regular portfolio. Maybe that will change. I think a lot of investors just decided to, open up a Coinbase account and hold some. I think I saw an interview with somebody we both know, Tom Sosnoff, the other day, and he said, as the founder of Tasty Trade, I saw this interview that he had done. He said, look, we offer crypto, but it ends up being dead money. People buy it and they hold it. And they're not, it's not a trading vehicle most of the time, right? And I don't know how true that is. I believe Tom, he's got a brokerage firm. He has the inside data. But when I hear that, it makes me think, the stability of it is just because there is a stickiness to it, the stickiness of it that, maybe that's how most retailers are individual and do-it-yourself traders are dealing with it. But yeah, I don't think it finds itself as a, component of, I guess an alternative portfolio would have.
Well, how can an advisor build a portfolio with it if they have to attach the volatility? Because if you have the good, which, as long as you didn't buy it in March of this year, you're up money on it. It's near the highs, but you've got to also get the volatility when you're designing the portfolio. And so,
you do that with options, right? You can do options on a handful of the futures based like BITO.
Yeah, but most advisors aren't going to know how to do options.
No, that's true. But we would.
Well, yeah, no. If I was, so let's say, so if I wanted to buy Bitcoin and hedge it, we know how to do that. But I'm just saying,
we did one of those. We actually started a hedged Bitcoin strategy just in one of our test accounts, right at the peak. And the hedging worked, but we put we put Zega money in it, like it was real investments. I was like, oh great, we rode this thing from 68,000 to 15,000, probably in the worst period that you could have picked. The hedging worked, but still, it wasn't anything anybody was interested in, right? We didn't get a single advisor who was like, oh yeah, that sounds like something I'd like to look into.
No, it's not, and my individual clients, there are some who probably, there are some that hold Bitcoin adjacent stuff or, maybe the Bitcoin ETF, but by and large, you're right. I don't have anybody coming to me being like, I really need a Bitcoin strategy. No.
Nope.
Not at all. But somebody's buying the ETFs.
You have had people come to you saying they want a gold strategy.
Yes.
Before. Hey, I like gold. Can you sell some calls for extra income? Can you make it an income generator? But I still want the upside, at least most of the upside capture. Sure. We've had people come to multiple. Well,
that's gold doesn't pay a dividend. So that's one of the things. They're like, oh, let me hold, let's say GLD, the ETF. And then could I generate, could I in my separately managed account sell covered calls on it? Is that something you guys could do? It's a way to generate a dividend on something that doesn't have a dividend, and other people have asked to hedge it, which is
strong option market on gold, especially GLD.
Yep.
ETF. Yep.
All right. That's it. I'm calling
That's it. All right. Sorry.
What,
I almost got you off.
Yeah. Well, I had about a half hour of grievances against my New York Yankees who can't seem to.
You should be used to it being a New York fan at this point because the Giants aren't giving you any relief.
So the Giants are now 1-10. New York Football Giants are 1-10 all time in the new MetLife Stadium at night.
Yeah, I think I've been
What's wrong with that stadium? I haven't been to the new stadium. I obviously was at the old stadium. Is there anything wrong with the new stadium?
Besides the performance of the team? No.
Yeah.
It's fine. Stadium's great.
Okay.
There is some, what? I shouldn't say that. I think there's some criticism of the turf, right? Which is why, maybe we, end up having more injuries. I don't know. But no, it's fine. My seat's there right by a nice hot dog stand. And there's this great nacho stand that's right by my seats, as you go into the, you go back under towards the, where all the food is. Lots of food. Yeah, it's great.
Yeah, no, I love the old stadium. There was nothing wrong with the old stadium.
Just get a nice sausage and pepper sandwich. Love that with some mustard on it.
The food's got to be good because people have to take a break from the awful play.
Oh, yeah. Just make sure you should bring your gold to pay for it because it's not cheap. Anyway, nothing about a game is cheap.
Yeah, we'll talk about a captive audience, right? You're sort of stuck there, and it's not cheap. Did I tell you, by the way, that we lost the Arizona Coyotes? I may have mentioned this. The hockey team.
What sport is that?
Stop. It's hockey.
Oh, hockey. Okay.
But apparently we are now part of the territory for the Las Vegas Golden Knights hockey. So we get their games on our local TV here. Like I'm flipping through and I see like the Las Vegas Golden Knights pregame show. I'm like, why are we getting this? Apparently we're in the market now. That's
I wouldn't even know what it is.
Well, you only have the Stanley Cup winning Florida Panthers there.
What? In Florida?
Yeah. Any recommendations, Jay?
No, I'm good. I recommend our podcast.
All right. Jack Schwager, Market Wizards. There you go. It's great. Good group of books. So read those and that's it. All right. We'll be back next week and we'll say things that may or may not make sense. Until then, thanks, Jay. We'll talk to everyone soon.
Thanks, Derek.